and welcome to our webinar, Tax Tips for Newcomers. My name is Riley Cohen, and I'm the CEO of CanadaVisa. I've been looking forward to this webinar myself, and I'm excited to welcome you and introduce you to our guest from H&R Block, Yannick Lemay. H&R Block has been Canada's leading tax preparation firm for more than 60 years now, and has more than 1,000 locations across Canada, as well as various locations outside of North America. H&R Block offers tax advice to new Canadians filing taxes for the first time, and can also double check your return if you have already filed. Yannick is a tax expert with H&R Block Canada, whose vast knowledge of Canadian tax filings helps clients navigate the process easily while identifying the many tax benefits and credits available to them. Yannick's deep understanding of current tax regulations can be particularly useful for newcomers to Canada, students, and those filing for the first time. Yannick will present today for about 30 minutes, after which we'll have a Q&A session with questions we select from the chat throughout the presentation. Remember that the chat is public, so please do not share any personal information such as your phone number or email or anything private. These messages will be removed from the chat anyways, but please do not share any personal information in the chat. That being said, we encourage you throughout the presentation to ask as many questions as you like, and our moderators will be saving those questions for the Q&A session at the end of the webinar. So with that being said, once again, we thank you for joining. We're super excited for Yannick to present, and I'll hand it off now.
Thank you. Yes, good morning. Thank you for having me. I'm excited to see we have an audience from so many places all around, all different provinces, different countries. So that's great. So yes, let's start with this presentation. Are you sharing the, do you have it on the screen? There we go. Thank you. We have the visual, so hopefully you can hear me well. Hopefully you can see also the presentation. So tax tips for newcomers to Canada is what we'll be covering today. Filing your tax return in Canada can be, for some of us, and maybe a lot of us, can be overwhelming, especially for the first time, because there's a lot of things we need to think of, a lot of documents we need to gather. It might be also a different system to what you're used to in your own country. So that's why we're having this presentation today, so you feel more confident filing your taxes either this year or next year when you do file your tax return for the first time. All right, so welcome to Canada. We did talk already a bit about H&R Block, but mostly what's important to know is that, yes, we do have more than 1,000 offices across the country in all provinces, but you don't have to come in an office to get our services. So that's even if you're not in Canada, for example, I saw in the chat some of you are outside the country, you can still file your taxes with us. You can do it online. So you go on our website, hrblog.ca, and then you can reach out to a tax expert online, and you can share the documents as well on our secret platform. So this is something you can do. You can ask your questions as well. Make sure you have all the right documents. So this is something you can do remotely. All right, let's see what we'll be talking about today. So first, common tax terms, the general functions of the Canada tax system, so how it works, what are the deadlines, how much taxes you'll be paying on your income, what income you need to include in your Canada's tax return. We're going to cover a few credits, deductions, and benefits, and talk also about retirement savings, so the different plans that are available for us as Canadian residents. So let's start with common tax terms here in Canada. So the first one is the Canada Revenue Agency. You'll hear that name a lot. So this is the government body that is responsible for collecting the income taxes on behalf of both the federal and the provincial governments. There's an exception. So if you're a resident of Quebec, so I saw some of you in the chat are residing in Montreal, for example. So if you are in the province of Quebec, you file 2 tax returns per year. So you file one return with the Canada Revenue Agency for your federal taxes, and you file also a separate provincial return for the Quebec government. But if you live in any other province of Canada except Quebec, you file only one tax return per year. And on that same return, you will pay both your federal taxes and your provincial taxes as well, because then CRA is responsible for collecting both taxes. When it comes to tax return, so the tax return is the document we send to the CRA. So it includes the main document, right? So this is an 8-page document. This is your tax return, and to that tax return, we can attach different schedules that we are also sending to CRA, so the Canada Revenue Agency. Tax rate. The tax rate is the percentage of income tax that you're required to pay, both for the federal and the provincial governments, and this is based on your income. And when we talk about income, there are two types of income, not two types of income, but there's two definitions of income for taxes. So the first one is your gross income. Your gross income means the all income you've earned during the year. And then you can ask some deductions, and we're going to see some examples of those deductions together. And when you deduct those deductions, you get your net income, so your taxable income. And this is on that income that you'll be paying taxes at your tax rate. Then we have the word tax credit. And a tax credit is different than a deduction, and that distinction is very important for taxes. When we talk about a tax credit, so if you see this word, well, you probably see this word often because in Canada, there are more than 400 credits and deductions available for us when we file our return. So when it comes to a tax credit, is a credit that will reduce your tax bill. That means you calculate how much taxes you owe to the Canada Revenue Agency, and to that total amount, you will subtract any tax credit that you have. And this is different from a deduction, because a tax deduction is an amount that will reduce your income. So, and if you reduce your income, there are chances that the consequence of you having a lower income is that you pay less taxes, right? So, so this is the first consequence, but also when you have a lower income, you might get access to additional tax credits that weren't available for you before. Because those credits, some credits, in order to be eligible for the credits, you need to respect a certain income threshold. Tax deadline. This is an important one. So the tax deadline in Canada is April 30th. So this is next week. If you need to file the 2023 tax return, this is next week. It's very, very important that you do respect the tax deadline to avoid penalties and interest also on the taxes that you owe. And even if you don't owe taxes to the Canada Revenue Agency, you can still owe penalties to the government. So you don't want to file your taxes late. If you have received during the year what we call self-employed income, so business income, for example, you were a Uber driver, or you were a Lyft driver, or you had other business income for the year, either you or your spouse, well, then you have until June 15 to file your tax return for the year. This year, June 15 falls on a weekend, so you have until June 17th, so the following business day, to file your tax return. However, even though you have until June 15 to file your taxes, you still have until April 30th to pay your taxes. All right, so you still need to figure out the amount you owe to the government before the end of the month of April. So this is what you need to keep in mind. Notice of assessment. The notice of assessment is the confirmation you will receive from the government that they have assessed your tax return. So that means they have received your tax return, they have identified the amount of taxes you owe, and they're sending you your bill, your tax bill, or they're sending you the refund, so the amount of taxes that they owe you. This confirmation does not mean that the government will not review your tax return later on, right? So it's very important to keep that in mind. You receive your notice of assessment, but you still need to keep all your receipts, all your supporting documents for at least 6 years, because 6 years is the period in which CRA can reassess your return, or they can ask for additional documents, they can ask for additional information and review and audit your return. The last word we have here on the slide is the T4 slip. So the T4 slip is the official document your employer in Canada will use to report your wages. So, and then you will need that slip to file your tax return, because this is the information you need to report on your tax return. Other common tax terms, so NetFile. NetFile is simply the electronic filing system that we have in Canada to file electronically your return with the Canada Revenue Agency. So instead of mailing your tax return, you can send it to the government electronically. It's definitely more efficient to do so electronically. It's also way faster to receive your refund, to receive your notice of assessment. So it is strongly encouraged to use to use a software that is compatible with NetFile. The personal amount is the floor, right? It's the floor threshold. So it's the basic amount on which you don't owe any taxes in Canada. So this amount for 2023 is $15,000. This is an individual amount. So you have one $15,000. Your spouse also has one $15,000. So the first $15,000 that you earned in the year is not taxable. That's what it means. The Registered Retirement Savings Plan, what we call the RRSP, is a tax default strategy that allows you to save for retirement. So that means you can contribute to that saving plan and make deductions on your tax return. So this represents this can represent a lot of tax saving. However, keep in mind that as newcomers to Canada, you cannot contribute to your RRSP the first year you arrive in Canada, because in order to be able to contribute to that saving plan, you need to have income in Canada the previous year. So the first year you arrive in Canada, you won't be able to contribute to that plan in most cases. A dependent is a child under the age of 18 years old. Then we have capital gain. So a capital gain is when you sell a property. It doesn't mean that you sell the property, right? It could also, if you give the properties to someone else, that also triggers tax consequences. So that's to keep in mind. And then the social insurance number is your personal identification number we use for tax purposes here in Canada. It's also the same number that you gave your employer, right? Because your employer will ask for that number, because this number is required to be able to, in order to be able to work in Canada. So if you already have a job in Canada, you already have that number for sure. All right, so the Canada tax system. So Canada has tax treaties with over 90 countries. And this is an important information because as a Canadian resident, when you file your taxes, you are taxed on your worldwide income. So that means for the period you reside in Canada, you need to declare all your income that you've earned in any country. And then by using those tax treaties that Canada has with other countries, you can claim tax credits for any taxes that you paid in a foreign country during the year. So that means you're not being taxed twice on the same income. A part-year resident. So a part-year resident would be someone that arrived to Canada during the year and came to Canada to establish a residence. So that means you will be taxed from the day you arrive to Canada until December 31st on your worldwide income. So on any income you've earned during that period in Canada and outside Canada. So for example, if someone arrived in Canada in April 2024, you will be taxed in 2024 from that income, on the income that you've earned starting in April until December 2024. So any income that you earned outside Canada between January and April will not be taxed in Canada because this was before you arrived in the country. It's very important when you arrive in Canada to establish the fair market value of any property that you owe outside Canada, and even in Canada if you owed any property in Canada before your arrival. So we're talking about any stocks that you have, any investments, any real estate property as well. So you want to establish, to identify the value of those properties, because it could have a significant impact when you actually sell those properties later on when you're a resident of Canada. Residency rules. So there are different types of residence for tax purposes in Canada. So when we talk about a resident, that's simply someone who lives in the country and calls Canada home. We said a part-year resident is someone who immigrates to Canada or immigrates out of Canada, but lived in the country part of the year. and that person is being taxed in Canada as a Canadian resident for that period of the year they reside in the country. In order to establish if someone is a resident of Canada, we are looking at what we call primary residential ties. And those are really simple. So we're talking if you have a home in Canada, and we're looking also if your spouse and your children moved with you in Canada. So if the answer is yes to both of those questions, then chances are you are a tax resident of Canada for the year. Other residential ties would include personal property in Canada, a bank's accounts, credit cards, savings in Canada, driver license, health insurance, and any other social ties that you may have. So the Canada Revenue Agency, the famous CRA. So in Canada, our tax system is based on residency. So it's not based on citizenship in comparison to other countries, right? So for example, in the United States, the tax system is based on citizenship. In Canada, it doesn't matter of what country you're a citizen. That means if you live in Canada, if you have those primary residential ties we've looked at, and then you are a resident of Canada, you file your taxes in Canada as a tax resident, and you're being taxed on your worldwide income, even though you're not a citizen of Canada. Right? So the fact that you're not a citizen of Canada doesn't influence how you should file your taxes. We said CRA oversees the collection of taxes for the government. They will audit a certain numbers of tax return every year. And that's what I said to you, and I will repeat it because it's very important. You need to keep all your supporting documents, all your tax slips and receipts for at least 6 years, because CRA can ask for those documents at any point of time during those 6 years. So you need to have those documents ready to send to the revenue agency in case they ask for it. And the way that our system is built is that you only provide those receipts, those slips, and those supporting documents. You only provide those when CRA asks for them. So there's no possibility for you to send those documents in advance to CRA just in case they want to look at it, right? So that's not how it works. You need to wait for CRA to send you a letter, and then you can submit the supporting documents based on what the letter is asking you. And it's the last point here. We have the last bullet we have on the slide. We say CRA can reassess your tax return if you fail to provide the proper documentation. So it's very, very important not to ignore any letter you receive from CRA. So CRA does not send a letter just for fun. Any letter they send to you requires your attention. So it's important you don't ignore those letters. Usually you have 30 days to answer those letters. And when you file your tax return, you can also subscribe to a CRA My Account. So this is an online account that we have with the Canada Revenue Agency. And by registering to that account, you will receive a notification by email every time CRA sends you a letter. So you can also access that letter online, so you can see it. For example, if you forgot to change your address with CRA, you can still have access to those documents online. Applying for social insurance number. So we said it, your social insurance number is mandatory. It's required to file a tax return. It's also required to work in Canada. So if you don't have one yet, and you know you'll need to file a tax return next year in Canada, it's very important that you ask for social insurance number. You can apply for social insurance number with using the form that is available at the Service Canada Centre. So on their website is servicecanada.gc.ca. It's important to distinguish Service Canada and the Canada Revenue Agency. So there are two different bodies of the federal government. So the Canada Revenue Agency, the CRA, only deals with taxes, right? So this is our tax authority in Canada. And then the Service Canada, they oversees different programs from different social programs federally, including the social insurance number, but they also deal with unemployment insurance. They also deal with child benefits as well. Tax rates. So this is a question that comes very often. So how much taxes am I going to pay in Canada? So tax rates are what we call marginal tax rate. That means, for example, here in 2023, on your first $53,000 of income, you'll pay a 15% tax rate federally. So this is only the federal taxes. But keep in mind that we've said we have a basic personal amount, right? So that means the first $15,000 that you earn, you don't pay taxes on that amount. So that 15% federal tax rate would be applied on your income earned between $15,000 and $53,000. Then for any income, any taxable income, right? So after all deductions, that taxable income that exceeds $53,000, you'll pay a tax rate of 20.5%, and then so on for the other tax brackets as well. Tax filing. So the importance of filing in time, I've said it already, I'm going to repeat it because it is so important. The consequences are very severe if you don't file your taxes on time. You can miss out on different tax credits, benefits, tax elections as well. When we talk about tax elections, that means when you file your return, sometimes there are elections that are available for you. So you need to make a choice on your tax return. And then if you file your taxes late, some of those elections may not be available for you. So that means you might lose out on some options that were available in your tax return simply because you're filing your tax return late. And that is even though you don't owe any taxes. And you don't have to be in a complex situation for those tax elections to be applicable for you. So please, please, please don't file your taxes late. We've said the deadline is April 30th or June 15th if you have business income. So if you were a gig worker, for example, during the year, you have until June 15th, so you have extra time. There are a lot of credits and benefits in Canada that are paid outside the tax return. So that means this is money the government will pay to you quarterly or every month, for example, but outside the tax return. And in order to get access to those credits and benefits, you need to file your tax return. So I'm thinking of, for example, the GST credit, the Canada Carbon Rebate, the child benefits if you have children. And if we talk about the Canada Carbon Rebate, this is a credit that is available for residents of most provinces, so not BC, not British Columbia, not Quebec, but other provinces in Canada. So if you reside in Alberta, Manitoba, Ontario, for example, it's a credit that you have access and there's no income limit. That means this credit is available to any resident of at least 18 years old in those provinces. So, and you get access to that credit simply by filing your tax return. If we take a family of 4, in Alberta, so you, your spouse, and 2 children under the age of 19 years old, only this credit, so the Canada Carbon Rebate, represents more than $1,500 the Canada government is paying to you throughout the year in quarterly payments. So you don't want to miss out on those benefits. And again, you get access to those benefits and credits simply by filing your tax return. So you want to file your return on time, not to miss out on any of those payments. International students. So international students would need to file a return in Canada if you worked while you were here in the country and have a Canadian source employment income. So if you have a Canadian employer, you earn wages during the year in Canada, you might need to file a tax return. Same thing is true also if you received scholarships in Canada, and those scholarships are taxable, because scholarships in Canada are not always taxable. They might be in some situations, so you need to verify if your scholarship is taxable. And there are a lot of criteria that will come into play to identify if your scholarship is taxable. So you need to make that determination first. And if the scholarship is taxable, you will need to file a tax return as well in Canada in order to pay those taxes that you owe. If you spend over 183 days in Canada and we don't have a tax treaty with your country, you will need to file the tax return in Canada as well. And in any other situations where you're considered a resident of the country of Canada, then you need to file a tax return as well. Because keep in mind that even though you're a student or an international student, a student from another country, when it comes to taxes, the treatment on your tax return is the same as any other resident of Canada. So the same rules apply. Everything we've talked about since the beginning of the presentation is true as well, even though you are a student for the year. Credits, deductions, and benefits. This is what makes you save money. So let's let's not forget about this section. We've talked earlier about the difference between a credit and a deduction, right? We said a credit will reduce your tax bill, so it will reduce the money you owe to the government. And when it comes to a tax credit, we have two types of credits. We have credits that will reduce the amount you owe to the government up to zero, right? So once you reduce your tax bill up to zero, then it's the end of it. You can add as many credits as you want. The government won't give you more money because your tax bill is already zero. And then we have what we call refundable tax credit. So refundable tax credit is money the government will pay to you even though you don't have even though you don't owe any taxes, your tax bill is already zero for the year. So it's basically what we say here on the slide. We say a deduction, in comparison, a deduction will reduce your taxable income, will get you access to additional credits and benefits. So for example, child benefits, right? So child benefits are paid by the federal government every month or every quarter, depending on the amount that is owed to you. And it's calculated on your income, the income of your spouse, and there's also a difference with the age of your children. So, for example, children under the age of 6 years old will get you more money than your children that are over 6 years old. So, so as I said, this benefit, so this child benefit, is calculated on your family income. That means if you add a deduction on your tax return, on you or your spouse return, then your family income will be lower, and then you can get higher child benefits because those benefits are calculated on your family income. So that's what I meant when I said a deduction can have an impact not only on your tax return, but also on other credits and benefits you might be eligible to. Parents should file Form RC66. So this is an important form. This is a form you will only file for the first year you file a tax return in Canada, because the GST credit, which is a credit the government is paying every quarter, the Canada carbon rebate that I've talked about, the child benefits, all those credits and benefits are calculated based on the tax return you filed with CRA. So the government already has the information they need to pay out those benefits. But when you file a tax return for the first year in Canada, there's some information the government wants to ask you that doesn't appear on your tax return. And so that's why you need to file for the first year this form, so the RC66, in order to avoid any delays in the payment of those three credits I've mentioned. So the GST credit, the Canada carbon rebate, and the child benefits as well. So some examples of credits and deductions. We have medical expenses. So medical expenses is a very common one. So if you paid for private health insurance during the year, you can include that expense in your medical expense tax credit. If you paid for private consultations as well, if you paid for prescription drugs, glasses, swimming goggles as well, if you have a prescription for those swimming goggles, sunglasses also with a prescription can be included. If you paid for physiotherapy, the general rule, so it's not always true, but the general rule is that most health professionals that are a member of a professional order in Canada, you can include those expenses on your tax return in most cases. And then post-secondary students can qualify for the tuition tax credit. So if you paid for a university, if you paid for a college in Canada, or even if you paid for a university or college outside Canada while you were a resident of Canada, you can include those expenses as a tax credit on your return. Every Canadian, we have an employment income. With employment income, we qualify for the Canada Employment Credit. So this is a small tax credit we have on our return. I've said it before, right? We have access to more than 400 tax credits and deductions. So there's a lot of things to think about. It's important to think about your situation, to see if there's anything you're not forgetting about your taxes, and to help you not forget about any of those credits and deductions you're eligible. We have on our website, so hrblog.ca, we have posted there a checklist. So it's a free checklist. You don't have to create an account. You don't have to register to anything. You can just access our free checklist, and this will help you identify the credits and benefits that might apply to your situation. So I strongly encourage you, before you gather all your documents, to go and have a look at that checklist. The last bullet here on the slide, we say if a family member has disability, there are tax credits available. So there's a form and the doctor will need to sign. So the form is the one we say here on the slide, so the T2201. So it's a form that is available online. So if you go on CRA's website, if you look for that name on Google as well, you will be able to print the form. It's a form that will need to be prepared by a health professional, usually the doctor, but it could be other health professionals as well identified on the form. And then you send that form to the Canada Revenue Agency. And the Canada Revenue Agency is the authority responsible to determine if you will qualify for the disability tax credit. So if you're not sure if you qualify, you don't lose anything by simply sending the form to CRA, and they will make the determination based on the information provided. Government benefits, we've talked about these already. So the GST credit, we said it's a credit paid quarterly. Then we have the climate action incentive. So the climate action incentive is the same thing that I call the Canada carbon rebate. It's simply that they changed the name this year. So you might hear both names. So the climate action incentive payment, the Canada carbon rebate, it's the same credit. And we said it's all provinces except Quebec and British Columbia. Retirement savings. So the most popular saving plan we have in Canada is the RRSP, so the Registered Retirement Saving Plan. The principle of this plan is quite straightforward. So that means it's a saving plan. In that saving plan, you can have access to different kind of investments. So you can have a saving account, you can invest in stock, you can invest your money in stock, in mutual funds, for example. So you have access to a different kind of investments. But the principle of this retirement plan is that when you contribute to that saving plan, you can deduct the contribution from your income on your tax return. That means tax savings, right? So you're saving taxes on your return, and then you'll get more money on your child benefits. You might get access to other credits as well. So, but again, as I said, don't make the mistake, because we see this mistake a lot in practice. The first year you file a tax return in Canada, you cannot contribute in most cases. So 99.9% of the cases, you cannot contribute to your retirement saving plan, because to be able to contribute to that saving plan, you need income in Canada the previous year. So if you arrived in Canada during the year, in most cases, you won't have wages or employment income in Canada the year before. The amount you can contribute to the RRSP, so to that registered saving plan, will be identified on the notice of assessment the Canada Revenue Agency will send to you. So once you file your tax return, we said you will receive your notice of assessment, and on that document, it will be identified the maximum amount you can contribute to your saving plan for the next year. Income earned in the plan isn't taxed until the money is withdrawn. So you deduct your contribution for your income. Any income earned in the plan for several years until you withdraw the money won't be taxed. So you will only pay taxes when you withdraw your contributions. So there, and then here we're talking about other US plans. So if this is something that is applicable to your situation, I suggest you reach out for professional help to make sure you make the right tax treatment of those contributions on your Canadian return. So the H&R Block advantage. So there's a lot of advantages to file with H&R Block, but not only H&R Block, I would say with a tax professional, because I've said it, there's a lot of things you need to think about for your tax return, and the potential of the consequences of a mistake on a return can be very, very dramatic. So that means it can have a significant impact for more than 1 year. It can have an impact on several years. You will be filing a tax return in Canada. So it's important that you get the right information. It's important also to be careful when you compare your tax situation with the tax situation of a colleague, for example, that would be in a similar situation. But sometimes your colleague is in a very similar situation, but there are small nuances between your two situations, and those small nuances can make a big difference on your tax return. So make sure you get the right information. With H&R Block, you can get a free estimate. So if you come in the office to ask questions, you come with your documents, then we can help you identify your tax requirements in Canada. It doesn't require you to file your taxes with us. Also, if you already filed your tax return, so for example, you filed your 2023 tax return already, and you want us to verify it, so to have a second look at that return, we can do so for free. So this is a free service we offer. We call it the free second look. So you come with your tax return in the office, we'll get you, and then we'll let you know if you missed out on any credits or benefits. So this is something that I definitely advise you to do, because it's free, it doesn't cost you anything, and then you'll have the peace of mind that your taxes have been filed correctly. You're not missing out on any credits and benefits. With H&R Block, so we have what we call the instant refund. So the instant refund means when you come in the office, file your taxes with us, if you're eligible, we can give you your money, so your tax refund right away. So you'll have it the exact same day. You don't have to wait for CRA to process your return. So that's what we call our instant refund service. And then our pay with refund service means you can pay for our fees with part of your tax refund from the Canada Revenue Agency. So you don't have to take money out of your pocket to pay for our services. So that could be an option as well. If you're hesitating, for example, to seek the help of a professional. So I've said it when we started the presentations, we have different filing options. You can come in an office with or without an appointment. You can also use our remote service online. So you don't have to leave your home. You don't have to be physically in Canada. It's a whole process you can do 100% remotely online with electronic signatures, with using our secured portals. So you don't have to come in the office. I believe this is all I wanted to share with you this morning. Hopefully this presentation has been helpful and will help you make the right choices to file your return in Canada.
Thank you so much, Yannick. A lot of information in there, and we really appreciate it, especially for those who are filing taxes for the first time. I just want to remind everyone that this session is recorded. And so if there's parts of Yannick's presentation that you maybe want to take a second look at, we'll send you over a link to the recording by email after the webinar ends within 24 hours, so that there's a section that you're more interested in and want to rewatch, you'll be able to do that. We're going to move into the Q&A sort of portion of our webinar now. And we have a lot of good questions to answer, so I don't want to waste too much time, but please, during the Q&A session, if you have more questions or want to follow up, continue to ask questions in the chat below, and we'll try to pull out some to answer. So the first question we received was by email regarding the carbon tax incentive. I hope I said that well. But essentially, this person had zero income for 2023 as they landed in 2024 in Canada as a PR, and got mail from the CRA saying that they couldn't process their carbon tax rebate because they didn't provide their world income information. So what should this person do, or how should this person approach the situation?
Correct. And this is a situation that will happen a lot with newcomers in Canada because CRA doesn't have the information. That's why they're reaching out to you to make sure they have the correct information to calculate that payment. Because we said the Canada Carbon Rebate, or what was previously called the Climate Action Incentive Payment, is something you are eligible to if simply by being a resident of the province, any province except British Columbia and Quebec. So it doesn't matter how much income you earn during the year. It doesn't matter if you are a student, not a student. It doesn't matter if you have children, no children. You are eligible if you're a resident of that province and you're at least 18 years old by the end of the year. And this is a payment that is made quarterly. So for example, if you moved in Canada in April 2024, you will file a 2024 tax return next year, and then you will receive the Canada Carbon Rebate starting in July next year. But before July, the Canada Revenue Agency needs information to be able to pay to you the credits or benefits that would have been calculated on your previous year income, but you weren't in Canada, so you might not have filed a tax return for that year in Canada. So they want you to provide your worldwide income, and that's using the form we've mentioned in the presentation, so the RC66. So this is the form you will use to inform CRA of any worldwide income you had in the 2 previous years. And that will help CRA make the determination if you're eligible for the GST credit, the Canada Carbon Rebate for those years. It doesn't mean you will be taxed on that income in Canada, because if you weren't a resident of the country for those years, you're not being taxed on any income you've earned outside Canada. But they still need that information to pay those credits to you. So don't ignore the letter, because this is money you leave on the table.
Awesome. Okay, and on that topic, Sanjay asks, do you have to report the income you've earned before you arrived in Canada?
So when you file your tax return, you need to report the income you earned before you became a resident of the country for the year. But that income is not reported on your total income. So if you look at your tax return, you'll see the different lines with different types of income for the year, and then you'll have your total income. That's not where you will report the income you've earned before you became a resident of Canada, because you don't want to be taxed on that income, because it was earned outside the country before you were a resident of Canada. So you're not being taxed on that income. But for the same reasons that we've said, so in order to be able to receive the GST credit, your child benefits, the Canada Carbon Rebate, CRA needs to know the income you've earned before you arrived in the country for the year. And that's why you need to declare that income, but not in your taxable income.
Great. And what kind of supporting documentation do you have to submit when you report foreign income?
It depends really on the type of income and the country you're coming from. But if you file your return electronically, or if you file the form, the RC66, either electronically or by mail, you're not attaching any supporting document to that form, right? You will only submit any supporting document if CRA asks for those documents directly to you. So in other cases, you simply keep those documents with you. So these documents could be, for example, the tax return you filed in a foreign country, a copy of your checks that you've paid income taxes, for example, to other countries, or any other tax official documents from your own country.
Right. Dharmesh asks on this topic as well, where do I go to check to see if my country has a tax treaty with Canada?
So this list is available on Canada's Revenue Agency website. So if you Google it, if you look at it, you'll see there's a whole list of countries where Canada has a tax treaty. You can even have access to those treaties online. So it's not something, it's something that is made available to the public.
Great. Trista asks, if I have both T4 and self-employed income, is my deadline April 30th or June 15th to file tax?
So if you have during the year, either you or your spouse, business income, so that means self-employed income or gig work, or you were Uber driver, you had, or you sell art online, for example, using Etsy or what are other platforms there are, you have until June 15 to file your taxes. And this is true for you and your spouse, even if your spouse doesn't have any business income for the year. But what we need to keep in mind is that even if you have until June 15 to file your tax return, you have both, until you and your spouse, until April 30th to pay your taxes. So you want to figure out this amount before the end of April anyways.
Right. On this topic, Katerina asked, do we need to pay taxes for things, for example, sold on Facebook Marketplace or those kinds of cash transactions?
The answer is yes, in most cases. In Canada, the premise is we are taxed on our worldwide income, and any income you've earned is taxable, right? That's our premise, that's our first principle. And then you can see if any exceptions or any deduction is applicable to your situation. But if you're selling something on Marketplace, well, it depends, right? Because sometimes people will send on Marketplace a personal item, right? So they will sell, for example, chairs for your patio. But if you're selling those chairs at a price lower than you actually paid for the chairs, then this is not an income, right? This is a loss on the sale of those chairs. And because those chairs are a personal item, you cannot include the loss on your tax return.
Right. Ravi asks, can things paid in cash be claimed as expenses to reduce taxes? Does it matter how you paid for the item?
It does not. Yeah, no, sorry. It does not matter how you paid for the item, but you need to be able to provide supporting documentation to prove how much money you've paid and how it was paid, right? So it cannot just be something that came out of the blue. You need even though you paid with cash, you probably received a receipt, right, from the merchant. So you will use that receipt, and that receipt will mention, for example, paid in cash. So you will use that receipt for your taxes.
Right. Trista asked if about marginal tax rates, and maybe you can explain that one more time. Does that mean if I earn 60,000 and I move up to the higher bracket, that everything is now taxed at the higher tax rate, or how does that calculation work?
Yeah, so this is a question we hear a lot. So when we say marginal tax rate, that means you're only taxed at a higher rate for your income that exceeds the threshold. So in our presentation, we said, for example, up to $53,000, you're being taxed at a 15% rate. Over $53,000 and up to $106,000, you're being taxed at 20.5%. But that 20.5% rate only applies to that income between $53,000 and $106,000. So it does not apply to your income in the first bracket, so before $53,000.
Nice. Pablo asked, his family is moving to Canada in September, so congratulations. But they have investments and various incomes in Mexico. There's agreements, obviously, between Mexico and Canada to avoid double taxation. But what should he do in the meantime to make sure that he's not double taxed?
Well, the first thing is, and we've mentioned it in the presentation, when you move to Canada, the day you move to the country, you need to identify the fair market value of those investments you have outside Canada, so in Mexico, for example. And that fair market value can be identified with by your financial advisor, for example, the bank responsible for managing your money. They can provide you with that information. It's especially something easy to get access to if your investment are on the public stock market. So you simply take the value of that day you move to the country, and then you keep that information for yourself. You don't need to send it to CRA, but you need to keep it for yourself, because then it might be useful later on. So if, for example, if those stocks, you decide to sell them after you became a resident of Canada, then you will need to calculate the capital gain on that disposition, right, on that sale of property. And then at this time, it will become very handy to have the fair market value of the stocks when you move to the country, because this is what you will use to calculate your capital gain. So in other words, in Canada, you're not being taxed on the disposition of a property on the value that you accumulated before you moved to Canada. So that's why it's important to have the fair market value the day you moved to the country.
Right. Mohibul asks if it's possible that Quebec residents could have a different income assessment from the CRA and Revenue Quebec.
When you're a resident of Quebec, you do file 2 tax returns. So one with the CRA, Canada Revenue Agency, one with a Revenue Quebec. So you will receive 2 notice of assessment. And in some situations, there might be some discrepancies, so some differences between the 2 assessments. That is because we have some laws are applied differently, or some laws are different between the income tax law with Canada and the income tax law we have in Quebec. And one example of this that is very common is when your employer in Canada is paying for your health insurance. So the federal government says this is not taxable. In Quebec, we say this is an income that should be taxable and included on your tax return. So that means you will have a higher income on your Quebec assessment than you will have on your Canada assessment, because we don't have the same definition of income. So this can happen.
Trista asked about tuition credits, and are you able to roll over tuition credits to the next year if you have higher income the next year?
Yes and no. So that means your tuition tax credit on your federal return. So in Canada, we're excluding Quebec. In Canada, it is mandatory to use that credit for the year you have enough income to use it. And then if you don't need all your tuition tax credit to bring your taxes down to zero, then any amount exceeding of that tax credit can be rolled over to the following years. But it's not a choice. So you don't make that decision. It's only if you don't need it for the year, then any exceeding amount will be rolled over.
Right. Bobby asked a good question, which I'm very curious about too, is what's the tax penalty for removing money from your RRSP account?
From removing?
Yeah, let's say if you sell some investments in your RRSP account.
So if you withdraw money from your RRSP, there are no penalties in Canada compared to other countries, for example, the US. In the US, you have a penalty for early withdrawal. This does not exist in Canada. That means you can withdraw money at any point of time from your RRSP. There are two situations where you won't pay taxes for the year. This is if you withdraw money to buy your first home in Canada or to go back to school. So some conditions apply, but these are two situations where you can withdraw money from your RRSP and not being taxed right away on that withdrawal. In any other situations, when you withdraw money from your retirement saving plan, you will add that withdrawal to your income for the year. So that means you will pay taxes at your tax rate on that withdrawal on your tax return, but there are no penalties. You're simply paying taxes on that income.
Right. Somebody asked about the child care benefits, and in the first year of landing in Canada, they were asking how should they approach that, given that they don't have any prior income in Canada in previous years.
So that's a good question. So it's the same form that we've mentioned. So the RC66 is the form you will use. You will use for the year to declare any income you've earned outside Canada in order to get access to those child benefits or the Canada Carbon Rebate, the GST credit as well. But there's another form, and I believe it's the RC291. If you let me confirm this in just a second, that could be more. Or is it RC91? So many forms, so many names.
A lot of great questions in the chat. So thank you for sticking through and watching all this. We appreciate your time. We'll be also ending the webinar relatively shortly. So please, any questions you may have that you want last minute questions answered, now's the time to write them out and put them in chat so we can get them answered.
So it's not the RC291, it's the RC151. So, so if you don't have children, you'll be filing the RC66. And if you have children, you'll be filing the RC151. But both forms have the same purpose. It's both to include your income earned outside the country, get access to the GST credit, Canada Carbon Rebate, and the child benefits if you have children.
Right, great. Somebody asked about work they've done for which they don't receive a T4 slip. How do they report that on their income tax?
So your employer in Canada is required to give you a T4 slip at the end of the year, or if your employer shut down their business, for example, during the year, they have a short delay after after they close their business to provide you with that T4 slip for the year. And And it's your responsibility to do all you can. So to try to get access to that T4 slip. In some situations, we understand it might not be possible for circumstances out of your control. In this situation, you need to identify from the best you can the income you've earned during the year. You can use, for example, your pay slips or your pay stubs that you have that give you the information on your wages you've earned, the taxes you've paid as well during the year. So this could be another source of information you can use. But also, because you don't have a T4 slip with you, it doesn't mean your employer hasn't filed a T4 slip with the CRA. So you should also check online, so on CRA My Account, so your online CRA account, or ask a tax professional to go and see for you. So for example, this is something we can do for you at H&R Block. We can go and ask CRA if there's any T4 slip under your name with the government, so we can get access to that information.
Awesome, thanks. And we're nearing the end of our webinar now. I just want to take the time to thank you, Yannick, for answering all of our questions. I know there was a lot of questions thrown at you on a lot of different topics, but we really appreciate your time. And we look forward to sort of sending this presentation around for the people that missed the webinar or couldn't make it for some reason. So once again, you'll receive a recording of this webinar in your mailboxes, should be in the next 24 hours. Filing taxes is a super important part of your life in Canada and can also have implications on immigration applications you may make in the future. So for example, when submitting your citizenship application, this will be some years down the line, there could be potential negative effects on your applications if there's discrepancies between your tax assessments and your residency assessments for the year. So it's super important to have a good understanding of this to set yourself up right for the future. Yannick, do you have any closing statements?
I don't. I said everything I wanted to share. So file your taxes on time, and thank you, everyone.
Great. Thanks, everyone. We appreciate it. And Yannick, thanks again once from CanadaVisa. We really appreciate your time today.
Yes, thank you for having me.
Great. Have a good day. Bye, everyone.